Good day. Welcome back to Introduction to Financial Accounting 2. In this lecture, we are going to take a look into Chapter 12, which covers accounting for partnerships. This chapter is going to look into three learning objectives. First one, we're going to discuss and account for the formation of a partnership. Then we're going to try to explain how to account for net income or net loss for a partnership. And finally, we're going to end with trying to explain how to account for the liquidation of a partnership. So let's begin. So let's start with the first learning objective. We'll try to discuss and account for the formation of a partnership. But before we do that, let's try to understand what is a partnership. A partnership is simply an association of two or more persons to carry on as co-owners of a business for profit. You typically find partnerships in small retailers, services, or manufacturing companies, or in accounting offices, lawyers, and doctors. So what are the characteristics of partnerships? We have multiple areas of unique characteristics of partnerships. Those include the association of the individuals, so dealing with the partnership as a legal entity and as an accounting entity. And for the taxation purposes of the partnership, the net income is not taxed as a separate entity. We also have mutual agency, which dictates that the act of any partner is binding on all other partners so long as the act appears to be appropriate for the partnership. A partnership also typically has a limited life. So the dissolution occurs whenever a partner withdraws or a new partner is admitted, and the dissolution does not mean that the business ends. A partnership also typically has unlimited liability, where each partner is personally and individually liable for all partnership liabilities. One more characteristic of partnerships is the co-ownership of property, where each partner has a claim on total assets, where this claim does not attach to specific assets, and all net income or net loss is shared equally by the partners unless otherwise stated in the partnership agreement. Quick conceptual question. Says all of the following are characteristics of partnerships except for A, co-ownership of property, B, mutual agency, C, limited life, or D, limited liability. And of course, from the characteristics we've covered so far, we know that the one that is not a characteristic of a partnership is the limited liability. We learned that partnerships have unlimited liability. Now, since partnerships typically have unlimited liability, there are special forms of business organizations that are often used to provide protection from unlimited liability to the owners or the co-owners. So we have special partnership forms such as limited partnerships, limited liability partnerships, and limited liability companies. Now let's look at some advantages and disadvantages of different types of partnerships. Starting with the regular partnership, a major advantage here is that a regular partnership is simple and inexpensive to create and operate. On the other hand, a disadvantage of a regular partnership is that owners or the partners are personally liable for business debts. Limited partnerships, on the other hand, have an advantage where the limited partners have limited personal liability for business debts as long as they do not participate in management. Another advantage is that general partners can raise cash without involving outside investors in management of the business. So you see from the illustration here that in limited partnerships we would have general partners and limited partners. On the other hand, we have some disadvantages of this kind of partnership. A disadvantage, first disadvantage is that general partners personally are liable for business debts. Another one is that that these kind of partnerships are more expensive to create than regular partnerships. And finally, limited partnerships are suitable for companies that invest in real estate. The third partnership type is limited liability partnership. An advantage of this type of partnership is that mostly of interest to partners in old line professions such as law, medicine, and accounting, and that the partners are not personally liable for the malpractice of other partners. Where, on the other hand, a disadvantage of this type of partnership is that the partners remain personally liable for many types of obligations owed to the business creditors, lenders, and landlords, and that often limited to a short list of professions. And finally, to the last type of partnership, we have a limited liability company, LLC. A major advantage of this type of partnership is that the owners have limited personal liability for business debts, even if they participate in management. On the other hand, a major disadvantage is that these kinds of partnerships are more expensive to create than regular partnerships. Quick review question before we move on. Under which of the following business organization forms do limited partners have little, if any, active role in the management of the business? A. Limited liability partnership. B. Limited partnership. C. Limited liability companies. Or D. None of the above. And of course, the answer here is B. Limited partnership. Now let's take a general look at some of the advantages and disadvantages of partnerships compared to sole proprietorships and corporations. Advantages include the partnership allowing of combining of skills and resources of two or more individuals. They are relatively easier to form compared to corporations, and it provides a certain degree of freedom from governmental regulations and restrictions. And finally, it provides an ease of decision making compared to corporations. Where the disadvantages, on the other hand, is the mutual agency, the limited life of the partnership, and the unlimited liability. Now, in order to form a new partnership, we need what's called a partnership agreement. And what are the items that need to be specified in a partnership agreement? These include the names and capital contributions of the partners, the rights and duties of partners, the basis for sharing net income or net loss, the split of profits, whether it was 50-50 or 80-20 or anything like that. It also needs to specify the provision for withdrawals of assets. So it needs to regulate when a specific partner wants to withdraw some cash or sell a specific asset, and also needs to specify procedures for submitting disputes to arbitration and the procedures for the withdrawal or addition for a partner. Someone they want to include one more partner, or they want to eliminate a specific partner from the partnership. And finally, it also needs to specify the rights and duties of surviving partners in the event of a partner's death. Let us take a look at this illustration together to try and understand how to account for a partnership formation. The illustration says A. Rolfie and T. She combine their proprietorships to start a partnership named US Software. Rolfie and She have the following assets prior to the formation of the partnership. And then you have this illustration 12-3 that shows you the assets that each of the partners is bringing into the business. And here we have two requirements of this illustration. The first one is to prepare the entry to record the investment of A. Rolfie. And for A. Rolfie, we're going to debit cash 8,000 and debit equipment 4,000 and credit A. Rolfie capital of the total of the two, which is 12,000. Now, we only debited cash and equipment here because these are the two items that A. Rolfie is bringing into the partnership. For the second requirement, we need to prepare the entry to record the investment of T. She. And for T. She, we're going to debit cash 9,000 and debit accounts receivable 4,000. We're going to credit allowance for doubtful accounts 1,000, and the balance is going to be credited to T. She capital, which is also 12,000. And here we might think of a question that might pop into your head. So when a partner invests non-cash assets in a partnership, the assets should be recorded at their A. book value, B. carrying value, C. fair market value, or D. original costs. And for partnership accounting, in the case of a partner investing non-cash assets in the partnership, we would record these non-cash assets at their fair market value. So the answer here is C. Here we have a do-it-yourself exercise. The question says, indicate whether each of the following statements is true or false. Number 1, partnerships have unlimited life, corporations do not. And of course, this is false. Number 2, partners jointly own partnership assets. A partner's claim on partnership assets does not attach to specific assets, and this is true. Number 3, in a limited partnership, the general partners have unlimited liability. This is also true. Number 4, the members of a liability company have limited liability, like shareholders of a corporation, and they are taxed like corporate shareholders. And of course, this is false. Finally, number 5, because of mutual agency, the act of any partner is binding on all other partners. And from what we've learned so far, this is true. Now let's move on to the second learning objective of this chapter, which is to try to explain how to account for net income or net loss for a partnership. So how do we divide net income or net loss? The partners equally share net income or net loss unless the partnership contract or the partnership agreement indicates otherwise. And how do we do this? We do this when we do our closing entries. So we close all the revenue and expense accounts to income summary as normal, and then close income summary to each partner's capital account for his or her share of net income or loss. And finally, close each partner's drawing account to his or her respective capital account. So how do we divide the net income? We divide it based on income ratios. So the partnership agreements should clearly specify the basis for sharing net income or net loss, Typical income ratios might be fixed ratio or ratio based on capital balances, or salaries to partners and remainder on a fixed ratio, uh, or interest on partners, capital balance, and the remainder on a fixed ratio, or finally could be that each partner would get a salary and the interest on the partner's capital, and the remainder would be split into the fixed ratio. Conceptual question. Which of the following statements is correct? A. Salaries to partners and interest on partners' capital are expenses of the partnership. Salaries to partners are an expense of the partnership but not interest on partners' capital. Interest on partners' capital are expenses of the partnership but not salaries to partners. Or finally, neither salaries to partners nor interest on partners' capital are expenses of the partnership. And the correct statement out of these four statements is D. Neither salaries to partners nor interest on partners' capital are expenses of the partnership. Here we have an illustration to better understand how the process of dividing net income or net loss works. The illustration says Sarah King and Ray Lee are co-partners in the Kingsley Company. The partnership agreement provides for 1. Salary allowances of $8,400 to King and $6,000 to Lee. 2. Interest allowances of 10% on capital balances at the beginning of the year. And 3. The remainder equally is split between the two. Capital balances on January 1st were King $28,000 and Lee $24,000. In 2017, partnership net income is $22,000. The division of net income is as follows. The instructions: A. Prepare a schedule showing the distribution of net income. B. Generalize the allocation of net income. And here we can see the division of net income. So we create a table for the end or for the year ended December 31st, 2017, and the net income generated for that year is $22,000. Starting with the salary allowance, as we were instructed in the question, Sarah King is going to take $8,400 and Ray Lee is going to take $6,000. So that's a total of $14,400. And then we need to calculate the interest allowance on partner's capital. So Sarah's capital is $28,000. So taking 10% of that is going to give us $2,800. And for Ray Lee, his capital is $24,000. And taking 10% of that is going to give us $2,400. So these two add up to a total interest allowance of $5,200. So the total salaries and interest in this case for both partners is $19,600. Then we have an amount remaining of $2,400, and we're going to split it in the following manner. So the remaining income is $2,400, which is of course the $22,000 net income minus the $19,600 we calculated in the first part, which is the total salaries and interest. Now Sarah King is gonna take 2,400 multiplied by 50%, which is half of the remaining amount, and the result is going to be 1,200. Riley is also going to take the other half, which is 1,200. So the total of these two amounts is of course 2,400, and with this we distributed the full amount of the net income of 22,000. So in total, as a result of this breakdown, as you can see, Sarah King is going to take 12,400 in total, and Ray Lee is going to take 9,600. Now we can move on to the second requirement, which is to generalize the allocation of income. So of course, we're gonna create a general journal entry for this on December 31st. We're going to debit income summary for the total net income, which is 22,000, and then we're gonna credit Sarah King capital for the amount that she will take, which is 12,400, and we're going to credit Rayleigh's capital for the amount that he's going to take, which is 9,600. Here we assume another scenario. In this scenario, as you can see, the net income generated by the business does not cover the salaries and interest. So here it says prepare a schedule showing the distribution of net income, assuming net income is only 18,000. And as you remember from the net income breakdown we've done before, that the total salaries and interest that each of the partners should earn total to an amount higher than 18,000, which is 19,600. So what do we do in this case? In this case, we instead of having a balance, now we have a remaining deficiency of 1,600, which is 19,600 minus 18,000. So that means for Sarah King and Ray Lee, where they usually split the balance 50-50, now they are going to split the deficiency 50-50. So the 1,600 is going to be divided on the two, and each of them needs to contribute an extra 800 to the business to cover the deficiency. So Sarah King is going to take 1,000, or is going to put in 1,600 multiplied by 50%, which is $800, and Rayleigh is also going to need to contribute half of that 1,600 amount. So in this case, each of them is gonna need to contribute $800, which is going to be subtracted from their total salary and interest for each of them. Now remember, one of the main financial statements that we've learned before in Accounting 1 was the change of owner's equity statement, or the owner's equity statement. And now for partners, we have what's called partner's capital statement. And the main difference here is that instead of showing the change in the owner's capital for one owner, here we're going to split the statement into the two partners. So as you can see, we're going to start with the capital as on the beginning of the year, on January 1st, where Sarah King had contributed 28,000, Ray Lee contributed 24,000, which give us a total of 52,000. Now we're going to add all the additional investments throughout the year. Sarah King have put up $2,000 more. Ray Lee did not contribute any more additions to the capital of the business. And then the net income split, as we calculated in the beginning of this illustration. So for Sarah King, it was 12,400, and for Ray Lee, it was 9,600. And then we tally up the totals for each individual partner and for the partnership in total. And then we also need to take away any drawings that occurred during the year. And we know that Sarah King have withdrawn 7,000 throughout the year, and Ray Lee have withdrawn 5,000, which gives us a total of 12,000. So we're gonna subtract those specific amounts of the balance of the owner's equity, and we're gonna end up with the end of year capital for each partner. And in this case, the owner's equity balance for Sarah King, or we can call it King Capital, 35,400, and Rayleigh's capital, 28,600. And the partnership in total would have an owner's capital of 64,000. Now also think of the balance sheet and how we're going to represent the partnership on the balance sheet. Remember from Accounting 1, when we used to build or report a company's balance sheet, we used to have a single number or one figure for owner's equity. The only difference here is that we're going to split the owner's equity into each partner's capital. So as you can see in this partial balance sheet, the owner's capital or owner's equity segment of the balance sheet, we're going to have a split where we're going to show Sarah King's capital, in this case 35,400, and Rayleigh's capital 28,600, and both numbers are going to provide us with the total owner's equity, which is 64,000. Now we can easily create the division of net income based on the details given to us in the question. So for the salary allowance, we know from the question that LE is going to get 15,000 and RMA is going to get 12,000. So that's 27,000. Now, subtracting that 27,000 from the net income of 57,000, that means we're going to be left with a remaining income of 30,000. Breaking this down based on the fixed ratio division decided in the partnership agreement, where LE is going to take 60%. So we'll take 60% out of the 30,000. We're going to get 18,000, which is going to be taken by LE. The remaining 40% of the 30,000, which is 12,000, is going to be owed to RMA. And the total, we also going to total these two amounts to 30,000 to add to the last column of the totals, which going to give us the total division of net income. So LE, based on this, is going to get a total of 33,000. RMA is going to get a total of 24,000, and of course the total of the net income, which is 57,000. Now, how do we close this on the general journal? So we're going to create a closing entry for net income based on the calculations we've carried out. We're going to debit income summary, which is 57,000, and we're going to credit this to for the two partners' capitals, where LE's capital is going to be 33,000 and RMA's capital is going to be 24,000. Finally, let us move on to the last learning objective of today's lecture, in which we're going to try to explain how to account for the liquidation of a partnership, which occurs at the end of a partnership. Now, the liquidation process needs to end both the legal and economic life of the entity. And to liquidate a partnership, it is necessary to sell all non-cash assets for cash and recognize a gain or loss on the realization. We also need to allocate the gain or loss on realization to the partners based on their income ratios. And we need to pay partnership liabilities in cash, and finally distribute all the remaining cash to partners on the basis of their capital balances. Now, in a partnership liquidation, we have two scenarios that may occur. We have a scenario where we liquidate the partnership with no capital deficiency, or the liquidation could be with a capital deficiency. So let's start first with the first case of no capital deficiency, and let's go through this illustration to try and understand it. The illustration says A's company is liquidated when its ledger shows the following assets, liabilities, and owner's equity accounts. So on the assets side, we have cash, accounts receivable, inventory, equipment and accumulated depreciation on the equipment. And on the liabilities and owner's equity side, we have notes payable, accounts payable, R, our net capital, and P, carry capital, and W, Eaton capital. So we have three partners here. The illustration then goes on to continue with the details. It says the partners of Ace Company agreed to liquidate the partnership on the following terms. 1. The partnership will sell its non-cash assets to Jackson Enterprise for $75,000 cash. 2. The partnership will pay its partnership liabilities. The income ratios of the partners are 3:1 respectively. So ACE sells the non-cash assets, which include the accounts receivable, inventory, and equipment for $75,000, where the book value of these assets is $60,000. So you remember from the table, $15,000 was for accounts receivable, $18,000 for inventory, and $35,000 for the equipment, of course, minus the accumulated depreciation on equipment of $8,000. So the first requirement is to prepare the entry to record the sale of the non-cash assets. And to record this, we're going to debit cash, $75,000, being the cash that we received from Jackson Company for the sale. And we're also going to debit accumulated depreciation, which we know is $8,000. These two debits is going to be offsetted by the following credits: accounts receivable, $15,000. Inventory, $18,000, equipment, $35,000, and of course the remainder, which is the difference between the book value of these non-cash assets and the amount we actually realized, is going to be credited to gain on realization account, $15,000. The second requirement is to prepare the entry to record the allocation of the gain on liquidation to the partners, and the gain in this case was $15,000. Now we were told that the ratio of disbursement for the partners is 3:1. So basically, how do we understand this 3:1 fixed ratio? We assume or we total these numbers. So 3 plus 2 plus 1, that gives us 6. So we're going to assume that each gain is going to be divided into 6 parts, and our net is going to take 3 out of these 6 parts. So basically he's going to take 50%, and carry is going to take 2 out of these 6 parts, and Eaton is going to take 1 of these 6 parts, which is basically a sixth. So let's split this. So we're gonna see the gain on realization of 15,000. Our net is gonna take half of that, which is 7,500. Carry is gonna take 2 on 6, or 2 divided by 6 out of this amount. If we crunch these numbers in a calculator, we will see that carry is gonna take a third of the amount, so 5,000. And Eaton is gonna be left with a sixth of the amount, which is 2,500. The third requirement here is to prepare the entry to record the payment in full to the creditors. In this case, we're gonna debit notes payable of 15,000 and debit accounts payable 16,000. And of course, we're gonna pay these in cash, so we're going to credit cash account for the total of these two, which is $31,000. And the fourth requirement in the illustration is to record the distribution of cash. Now, if we go back to the cash ledger account, we will see that it has a debit balance of 5,000 from before the liquidation process began. And then we also added another debit amount of 75,000, which is the amount of cash that we received for the sale of non-cash assets. And it's going to have a credit of 31,000, which is the settlement of the receivable the payables amounts for the notes payable and the accounts payable. So the cash balance is going to be 49,000. And then we can move on to the capital ledgers of each of the partners, and we will see that our net capital, where he had a balance of 15,000, and then also received 7,500, which is half of the amount, the balance on the sale of non-cash assets. And then for Carey's capital, he had a beginning balance of 17,800 on the credit side, and then he also received a further distribution of 5,000, where he took a third of the balance. And Eaton capital, or the beginning balance on Eaton's capital, was 1,200, and then he also received 2,500. So based on that, when we close each capital ledger for each of the partners, we will know the specific amounts that represents each of these partners' capitals. And we can debit each capital for the correct amount, and the balance will be offsetted to the cash account of the total of the capital amounts. At the end of this, we can now create our schedule of cash payments based on all the information that we have gathered. And you can see that on this schedule of cash payments, we will begin with the balances before liquidation, where we had a 5,000 in cash. We had non-cash assets worth 60,000 on their book value. And of course, this is the assets side, and it will equal the liabilities plus owner's equity side based on the accounting equation that we all know. So the liabilities in this case were 31,000. Our net's capital was 15,000. Carey's capital was 17,800, and Eaton's capital was 1,200. After the sale of non-cash assets and the allocation of gain, we see that our cash have increased by 75,000, which is the amount that we received for the sale of non-cash assets. And of course, we are going to deduct the balance under the non-cash assets column because we sold all of these assets. So we'll subtract 60,000. On the capitals side, we will show the split of the amounts that are allocated to each of the owners. So 7,500 was allocated to Arnett, 5,000 was allocated to Carey, and 2,500 was allocated to Eaton's capital based on the split ratio that we have on the partnership agreement. So the new balances are going to be 80,000 for cash, 0 for non-cash assets. The liabilities are still 31,000. We haven't paid them, but the Arnett's capital is going to be 22,500. Carey's capital is going to be 22,800, and Eaton's capital is going to be 3,700. Then we show the step where we pay the liabilities. So of course our cash is going to be reduced by 31,000, and our liabilities is going to be brought down to 0. So we're going to subtract 31,000 from it. The new balances now are going to be 49,000 for the cash. Non-cash assets are now 0. The liabilities are also now 0. And the capitals for each of the partners are not going to be affected. Now the cash distribution to partners step number 4. We're going to subtract the exact balance of the cash, which is 49,000, and it's going to be given to each of the partners based on their capitals balances shown on their ledger accounts. So our net is going to take 22,500, Carey is going to take 22,800, and Eaton is going to take 3,700. And of course, we're going to end up with a 0 final balance for each of the accounts. A couple of quick review questions. The first one says the first step in the liquidation of partnership is to A. allocate gain or loss on realization to the partners. B. Distribute remaining cash to the partners. C. Pay partnership liabilities. Or D. Sell non-cash assets and recognize a gain or loss on realization. And of course, the first step, just like we've learned previously, is to sell non-cash assets and recognize a gain or loss on realization. So the correct answer here is D. Another question says, if a partner with a capital deficiency is unable to pay the amount owed to the partnership, the deficiency is allocated to the partners with credit balances, A, equally, B, on the basis of their income ratios, C, on the basis of their capital balances, or D, on the basis of their original investments. And of course, the answer here is B. The deficiency is going to be allocated to the partners with credit balances on the basis of their income ratios. Here we have another illustration on partnership liquidation, but in this case scenario we are going to have some capital deficiency. The illustration says Ace Company's ledger shows the following assets, liabilities, and owner's equity accounts. So on the assets side we have cash, accounts receivable, inventory, equipment, and accumulated depreciation. On the liabilities and owner's equity side we have notes payable, accounts payable, our net capital, carry capital, and eaten capital. If you notice, if you look closely, you'll see that the numbers here and the accounts are exactly identical to what we have or what we had earlier in the previous illustration. So let's move on throughout the illustration and see what is going to be different here. If you continue to read on the illustration here, you will notice the difference. So in this scenario, it says Ace Company is on the brink of bankruptcy. They sell merchandise at a substantial discount and sell the equipment at an auction. Cash proceeds from these sales and collections from customers totals $42,000, as compared to the $75,000 they received in the previous scenario. 1. Prepare the entry for the realization of non-cash assets. So here simply we're gonna debit cash, how much we received in cash, which is $42,000. Accumulated depreciation, $8,000. And this time we're going to debit loss on realization, which is going to be the difference between the balances on the debit side and what we have on the credit side. So what do we have on the credit side? We have accounts receivable, $15,000, inventory, $18,000, and equipment, $35,000. So we figure out the total of the credit side, and then we subtract the difference between the credit side and the cash and accumulated depreciation accounts from the debit side, and this is how we come up to the $18,000 that we record under loss on realization. The second part of the illustration says Ace allocates the loss on realization to the partners on the basis of their income ratios. If you remember, we said that our net capital is 3/6, Carry's capital is 2/6, and Eaton capital is 1/6. So this is their income ratios. So now we need to calculate exactly how the loss on realization is going to be allocated to each partner. So we start with our net capital, 18,000. We multiply it by 3/6. We get 9,000, which is half of the amount. Carry's capital, 18,000 multiplied by 2/6. And this is going to give us a third, which is 6,000. And for Eaton, we're going to get a sixth of the amount, which is 3,000. So we debit all of these amounts, and they are offsetted by a credit on loss on realization of 18,000. Third requirement in the illustration says prepare the entry to record the payment in full to the creditors. We know from the details in the question that we have a total amount owed to creditors of 31,000, which is 15,000 of that is for a note payable, and 16,000 is for accounts payable. So we debit notes payable 15,000, we debit accounts payable for 16,000, and we credit cash of the total of 31,000. Here we see how the payment of the deficiency is going to be settled. So if you refer back to the capital of each of the partners, you will notice that Arnett and Carey both have a higher capital than the amount that needs to be settled. So for that, we just record the or we distribute the balance before liquidation based on their standing capitals. But for Eaton, it's a little bit different because his capital is only 1,200 and he's going to be required to put in 1,800 more out of his own cash. So after receiving Eaton's payment of 1,800, our cash balance is going to increase to 17,800. And for now, we're going to leave Arnett and Carey's capital as they are. And we're going to record in the journal the amount received from Eaton. So we're going to debit cash 1,800 and credit Eaton capital 1,800. And with this, we close Eaton's share of the partnership. And then we also need to debit Arnett's capital 6,000. And we debit Carey's capital 11,800. And these two amounts are going to be offsetted by the total of the cash. So we're going to credit cash 17,800. The 1,800 collected from Eaton is going to be allocated to each of the other two partners as follows. Carey is going to get $720 and Arnett is going to get $1,080. And with this, we're going to get the following balances. So Eaton's capital is going to be closed. The cash remains at 16,000, but Arnett's balance is going to change to 4,920, and Carey's balance is going to become $11,080 after deducting the 720. So this is going to be recorded as follows. Arnett's capital debited for 1,080. Carey's capital is going to be debited for 720, and the balance is going to be credited to Fairley capital 1,800. And again, when we close the balances record is going to be recorded as follows. Arnett's capital is going to be 4,920. Carey's capital 11,080, and of course both of these total or balance to a $16,000 cash, which is the cash balance in the business. With this, we conclude the material in chapter 12. Thank you all for listening to this lecture, and I'll be happy to answer any questions that you may have. Thank you so much.